Hey everyone, welcome to this explainer. Look, if you're running a business that relies on heavy equipment or a commercial fleet, you already know the deal. Acquiring these assets, it takes a massive amount of capital. I mean, it's easily one of the most significant financial commitments your company will ever make. But once you finally decide you need to upgrade or expand that fleet, you're immediately hit with the ultimate dilemma. Do you navigate the dense, complex world of IRS depreciation to try and shield your income? Or do you focus on managing your monthly cash flow through commercial leasing? It's what we call the heavy equipment crossroads, and the path you end up choosing is going to dramatically impact your balance sheet.
So it all boils down to one seemingly simple question, right? Buy or lease? I mean, it sounds straightforward enough, but as we unpack the source materials today, you're going to see it is anything but simple. This single question sets up the ultimate compare and contrast journey we're about to take. On one side, we have the immense tax power of ownership. On the other side, we've got the cash flow predictability and the flexibility of leasing. Our goal today is to give you the exact framework you need to make the absolute best choice for your specific operation. To give you an idea of why mastering this is absolutely crucial, just look at this number. $2,560,000. According to IRS Publication 946, that is the maximum Section 179 expense deduction limit for tax years beginning in 2026. Just pause and think about that for a second. That's over $2.5 million of capital you can potentially shield from taxes in a single year. That goes straight to your bottom line. If you don't understand the tax code, you are literally leaving real money on the table. Here is our roadmap for today. First, the equipment acquisition dilemma. Number 2, demystifying IRS depreciation rules. Third, the power of Section 179. Fourth, the truck leasing alternative. And finally, number 5, navigating tax versus accounting.
All right, let's jump right into part 1, the equipment acquisition dilemma.
You know, when you're standing on a lot staring down rows of heavy machinery, you aren't just looking at trucks. You're actually looking at multi-year financial commitments that are going to ripple through every single aspect of your business. What this really boils down to is a choice between two very diverging paths. If you buy, you are committing to navigating the intricate and, let's face it, pretty dense rules of IRS Publication 946 just to recover your costs over time. But if you lease, you're opting for structures like track leases to keep your monthly cash flow highly predictable. And as you'd expect, each path has its own distinct set of rules, its own benefits, and yeah, some hidden traps too. Okay, moving on to Section 2, demystifying IRS depreciation rules. So let's say you decide to buy. Welcome to the world of depreciation. Essentially, this is the IRS's way of letting you recover your costs as your shiny new equipment inevitably wears out. Now, the standard method they make you use for most property, it's called MACRS, or the Modified Accelerated Cost Recovery System. And what's interesting here is that it isn't just a simple deduction. No way. It's a highly structured system that requires you to figure out your property's basis, determine its specific recovery period, and apply some pretty strict accounting conventions. It's basically designed to dictate exactly how quickly you're allowed to write off that new fleet. But hold on, before you can even use MACRS, your equipment has to actually qualify. And the IRS has some strict rules here. First off, you've got to actually own the property. You cannot depreciate property if you only lease it unless you retain what they call the incidence of ownership, which basically means you're bearing the burden of exhaustion and the risk of loss. Simply put, if you don't bear the risk of the truck breaking down, you can't claim the depreciation, period. The property also has to be used in your business, it needs a determinable useful life, and it has to be expected to last more than 1 year. So things like land, which doesn't really wear out, or your daily inventory, those definitely cannot be depreciated. Which brings us to Section 3, the power of Section 179. Now, you might be wondering, what if I don't want to wait 5 or 7 years to get my money back through standard depreciation? Well, enter the Section 179 deduction. This is a real game changer. It allows you to elect to recover all or part of the cost of qualifying property in the exact same year you place it into service. It is just a brilliant way to drastically lower your immediate tax burdens. Instead of trickling your deductions over years and years with standard MACRS depreciation, Section 179 lets you take the hit right up front, which keeps more of your hard-earned cash inside your business today. Let's put some real numbers to this, straight from IRS Publication 946, for the current and upcoming tax years. For 2025, the maximum deduction limit sits at a cool $2.5 million, with a phase-out threshold kicking in at $4 million. But check out 2026. That limit bumps up to $2.56 million, and the phase-out threshold rises to $4.09 million. You'll also notice there are specific, much lower limits for sport utility vehicles, sitting right around that $31,000 to $32,000 mark.
These limits just go to show exactly how much capital you can shield in a single year if you time your acquisitions just right. And believe it or not, the tax benefits actually just got even better thanks to Public Law 119-21. It's rather grandly named the One Big Beautiful Bill Act. You kind of have to love the creativity lawmakers use when naming tax legislation, right? But dry names aside, the impact of this is incredible. This act actually reinstates the 100% special depreciation allowance, what most of us just call bonus depreciation, for qualified property acquired and placed in service after January 2025. 100%. Now, if taking all of that is a bit too aggressive for your specific tax strategy, the bill thoughtfully provides an alternative 40% or 60% election. This is literally a massive, massive game changer for businesses looking to aggressively offset profits with heavy equipment investments. All right, let's shift gears to Section 4, the truck leasing alternative. Obviously, outright ownership and wrestling with depreciation isn't the only way to run a fleet. If your priority is, say, cash flow predictability and keeping those upfront costs low rather than immediate tax shields, commercial leasing is absolutely your path. And when we're talking about commercial vehicles, you're almost certainly going to run into a track lease. TRAC stands for Terminal Rental Adjustment Clause. What makes a track lease so unique is this seesaw effect between residual value and your payments. Basically, if you and the lessor agree the truck is going to be worth a lot at the end of the lease, your monthly payments drop. It's an inverse relationship.
So let's walk through how this actually builds in the real world. Step 1, you and the lessor agree on that estimated residual value, that TRAC amount we just talked about. Step 2, you get to enjoy a lower monthly rent during your term. But step 3 is the kicker. That is the end of lease true up. If you decide not to buy the equipment and the lessor sells it for more than the TRAC amount, you get a rebate. Awesome, right? But if it sells for less, you have to pay the deficiency out of pocket. That is a really critical financial risk to be aware of. To limit that downside exposure, you can also look into what's called a split track lease, which caps your potential lease end penalty to only a portion of that residual value.
To ground all these abstract financial concepts, let's look at some tangible current market data from Ryder. If you were to go out and lease right now, a tandem axle day cab is going to run you about $2,100 a month, and that includes full service and a max of 80,000 miles a year. A straight truck? That sits around $1,200 a month with preventative maintenance included. And if you just need a dry trailer, you're looking at an incredibly manageable $395 a month when bundled with on-demand maintenance. Seeing these fixed numbers, this is exactly why so many companies choose to lease. It completely transforms a massive, complex upfront capital expenditure into simple, reassuring cash flow predictability. And that leads us right into Section 5, navigating tax versus accounting. Okay, so we really need to untangle the tricky intersection of tax accounting and financial accounting here, because your business essentially has to keep two entirely separate sets of books. A few years back, a new standard called ASC 842 came along and completely changed how companies report leases for financial accounting. It forced businesses to put operating leases right onto their balance sheets. But drawing from a recent PwC analysis, here is what you absolutely must understand. ASC 842 does not impact the federal income tax treatment of your leases. Let me repeat that. Changing how you report your leased trucks to your bank or your investors absolutely does not change how the IRS views them. Your tax accounting methods for deducting lease payments remain exactly the same. You just have to make sure you keep these two worlds totally distinct. Wow, we've covered a lot of ground today. We've synthesized the predictable cash flow and the residual value risk of track leases and weighed them against the massive upfront track shields but potential recapture rules of Section 179 and bonus depreciation. So the question really goes back to you. Considering your own cash flow and your specific tax appetite, will you chase the massive upfront tax shields of ownership or play it safe with the cash predictability of a lease? The IRS has written the rules. Now it's up to you to play the game. Thanks so much for joining this explainer. We'll see you next time.